Hi, guys. I'm Phil Town from Rule One Investing, and today I want to talk to you about how long we can expect the kind of cost of living, prices of living to just keep rising. So, as we all know, maybe with the exception of the Federal Reserve, prices are rising everywhere. I guess they do know it, but they think it's temporary. And that means prices are rising from minimum wages to housing prices have gone right through the roof. Pretty much everything is going up. And we're seeing massive increases all across the United States, in fact, around the world. So this isn't going to be news to any of you guys who are out there watching this. But here's the thing. With the cost of living rising really fast, the biggest question is it going to do what the Federal Reserve thinks it's going to do and it's all going to re-normalize? We're going to, we ever see this thing drop back? Or this is just going to keep going up from here? And that's what I want to cover today. So you're going to get my opinion on this. Take it for what it's worth, but it's not going to be what the Federal Reserve says. So let's dive in. First, I want to tell you guys a little story I've told in my workshops about this little car wash place that had expanded to become the biggest gas station I've ever seen in my life, called Buc-ee's. Started off in Texas and now has expanded itself out across the southeast. And I saw my first one in Alabama. This is the biggest dang gas station I've ever seen in my life. It's like 100 pumps or something. Unbelievable. So back in the day, when they were first starting off in Texas, you could get a job at Buc-ee's. Just minimum wage, right? A couple of bucks, and then a minimum wage went up, and then $7 and so on. Today, this is no exaggeration, you can get a job I've watched these guys do it, just outside picking up garbage outside at Buc-ee's, and they're making $17 an hour minimum. Now, it's crazy how much this thing has jumped up, okay? So Buc-ee's is out to get good people, and they're going to have to pay them, which is great for all the people who are out there working. This is awesome. But this is a really good example of wages that are rising maybe very, very quickly and perhaps artificially. In other words, they're being driven up by something that isn't sort of baked into the normal wage labor world, right? And that little something is the fact that we've just come through COVID, and the government has been paying people a lot of money to make it through this whole COVID period on unemployment and unemployment benefits. So this has resulted in it making it very, very difficult for typically low-wage starter jobs to be filled. And we had another friend of ours down here in Moreland who shut down his little restaurant, right? They would compete down there in the breakfast, lunch world of fast food, and they shut it down. He just said, I got tired of trying to manage people who are at the absolute bottom of the barrel. And I said, so why don't you just pay people more and get off the bottom? And he said, because I can't raise my prices. The corporate world won't let me raise my prices up, so I had to quit. So this is why we should care about this thing. We all like making more money and everything, but we also got to kind of wonder what's going to happen out there to the cost of living. So raising the minimum wage is creating an imbalance in the labor market, and there's no question about that. But I think what's going on is far beyond just, somebody raising the minimum wage. I think what's going on is it's getting really hard to fill these lower end jobs. By the way, one of the things that's driving all of this forward is that last year, 2020, under Donald Trump's last year as president, in order to combat the stunning impact on the economy of everything shutting down due to COVID, the government printed about 35% of all the currency that's ever printed in the entire history of the United States. Now that's really should be a little bit of a wake-up call. 35% of all the money that's been printed since we became a country got printed last year and is out there in the economy. Not only that, you guys, but the Federal Reserve has been buying debt from the banks and from the mortgage markets to the tune of $120 billion a month. That's all new money pouring in That's over $2 trillion a year. And they've been doing that for years now. It's unbelievable. Yeah, the U.S. debt's going through the roof. And all of this is potentially creating the baseline for hyperinflation in the near future. So do we think that the Federal Reserve is right when they say that don't worry, prices are going to drop back to some kind of normalcy here pretty soon? No. This is like watching somebody on CNBC who owns a whole bunch of Apple telling you that Apple is awesome and you should buy more. They're just talking their book. And that's what the Federal Reserve brings. Do you really think they're going to come out and say, oh, I guess we put too much money out in there in the economy, so we're going to have hyperinflation now? They can't say it, because the moment they say it, all of us will start reacting to that and will change the way we consume, right? In hyperinflation type economies, consumption is massive. People get paid and immediately spend all of their money, because in a hyperinflation environment, that money is deteriorating in its buying power literally day by day. Now, we've never had super hyperinflation. We've had major inflation on its way to hyperinflation back in the 1970s, late 1970s, that we finally got under control with a heck of a big recession across 2 presidencies. And maybe that's what's going to happen here. By the way, here's another symptom of the whole process. Housing prices through the roof as a result of what? Lowest mortgage rates in history over the longest period of time. If you drop the rate, the interest rate on a mortgage, it makes the monthly payment less, right? By a lot. So, for example, if you've got mortgages that were normal my whole life, like 8% mortgage, and let's say you're paying $2,000 a month on an 8% mortgage, if that mortgage went down to 4%, chances are your payment would be around $2,000 a month. It would get cut in half. Well, housing prices have responded to that by going up. The more people in the market pursuing housing, the faster those prices rise. And over this last year, we have seen housing going up at extraordinary rates, something in some parts of the country at 15 and 20% over the last year. Now, what that means is that the rental prices will follow. That hasn't happened yet, but it will. And maybe it's already happening where you live, but it's going to follow just the way night follows day. Because as people pay more for those houses, they've got a higher mortgage to pay. They are going to have to rent that for more money. Also, I don't know about you, but right here where we are, around in Georgia, you can't find something to rent. It's unbelievably tight rental market. People have bought up the rental stock and it's gone. So it's going to be really interesting to see why the Federal Reserve would think that in this environment, this thing is going to just normalize. Rents aren't going to go down. Housing prices are very unlikely to go down unless there's a major crash or they kicking the interest rates up. So, and I don't think we're going to see a reversal of wages anywhere. You really seriously think that Buc-ee's is going to cut their wages of their guys out there cleaning up garbage? Not going to happen. So what should we do as investors? This is kind of the interesting thing. If the Federal Reserve isn't telling us the truth, then what should we do to kind of combat the prices are going to continue to rise everywhere, right? How do we deal with that? Well, here's some good news. Looking at the 4 places where you can put money over a long period of time, like 5 really, would be leave your money in cash, and we know what happens to that in inflation. There's been inflationary pressure on the U.S. dollar since 1935. From 1800 to 1935, the U.S. dollar remained the same purchasing power for 135 years. And then since FDR started changing, with social programs have been the major reason people are getting elected for the last 65, 85 years. And that has created a deterioration of the dollar. It's now worth 4 cents since 1935 when it was worth $1. So we will see the continued deterioration of the dollar. So you don't want your money in dollars. You could put your money into gold. Gold does fight off inflation over the long run. Since 1800, over 200 years, gold has gone up 300%. In other words, 3 to 1. You get $3 of buying power compared to what you had $1 of in 1800. Bonds have done very well. If you put your money in bonds right now and leave it in for a long period of time, you'll probably do kind of okay. Well, I could correct that and say bonds are one of the scariest things you could put your money into right now because they're at historic lows. And that means if the bond rates go up, if interest rates rise, then those bonds are going to fall. and you could lose a lot of money in bonds unless you just hold on to it to its expiration, in which case you're holding on to a bond that's paying 2% in a mortgage market that's paying, or an interest market that's paying 5%. So yeah, you could do that, but the bonds aren't great right now. In any case, historically over 200 years, $1,600 return to $1 invested 200 years ago in bonds. But then there is real estate. Real estate's done okay. It depends on, of course, where that real estate is, but it's done better than gold, not as good as bonds. All right. And then finally, the best one of all, of course, has been the stock market. It is 1,000,000 to 1, literally. $1 million of real money after inflation has accrued to somebody who put $1 into the market in 1800. So if you're in an inflationary environment, the place you want to be is the stock market. No question about it. It's going to do the best over the long run. Problem, of course, is the stock market goes up and down like crazy. You're going to have to be sure you understand that there could be a big market drop as part of this whole process. And when that happens, there goes 50% of your money, just like what could happen in the bond market. And we don't want that to happen to you. So we're going to encourage you guys, get out there and learn how to invest in individual companies. Buy them when they're cheap. Wait around in cash or in a short-term bond until you get that opportunity, and put your money into things that have long-term growth potential and a very strong potential to grow in an inflationary environment. That's what we call anti-fragile types of companies, and they're the best ones for you to buy right now. So if prices continue to rise, your money will be growing over time even faster than inflation by a substantial amount, right? 1,000,000 to 1 over a long period of time. So if you take anything away from this video, just know you should not keep your money sitting in a savings account. At least, not for a long term. Just learn to invest, you guys. It's not rocket science. I've got an excellent resource for you guys. We're hosting a free investing webinar for you so you can learn how to do this, and you can take it from the comfort of your own home. And this is going to teach you about investing in wonderful companies, good ones that are going to do well in inflation, that are anti-fragile, using the same exact value investing strategies that have made Warren Buffett and Charlie Munger billions of dollars. You guys, it ain't rocket science. Buffett and Munger have been teaching us about it for 50, 60 years. I'm going to link this over to you guys in the description below. It only takes a minute to register, but if you go to this thing, it can impact your life forever. It certainly has mine and thousands of people that we've taught. So if you want to do it, just get over there and you can implement these simple strategies that you'll learn. And now I'd really love to hear from you guys about this thing. Do you think prices of living, sort of the cost of living, are going to continue to increase? Leave a comment below. I'd really love to hear from you on it with your answer, and then I'll be sure to follow up with you guys. You guys, if you enjoyed this video and you feel it was valuable in teaching you more about whether or not I think the cost of living is going to continue to rise, just hit the like button and please share the video with your friends. Hey, and if you want more investing content, which you should, just subscribe to my channel. We got a ton of stuff here for you for free. And don't forget to click the button on the screen. We got a great free gift. And thanks again for watching.